Hey everyone, welcome to another video of Simplicity Investment Watch. Today is Monday, May 19, 2025. We're going to go through first the major markets with the CHWY Lucky 13 score. We'll go into the major economic news due out for the balance of this week. And finally, we'll go into what we've been doing during the tariff market panic. But first, let's get into the disclosure here. Okay, we do not give financial advice, and this information is not for investment decisions. This is for educational purposes. The stock market is risky, and any trade or investment is expected to have some or total loss. The use of derivatives increases investment risk or potential loss. Do your own research before any trade. Please consult a financial advisor or professional to determine what is a suitable investment profile for you, given your investment goals and objectives. Okay, now the major markets. So starting off with the Simplicity Investment Watch Lucky 13 scoring. It's my own technical score where I basically summarize multiple technical factors into one score. The scores go from 0 to 18, 0 being the most bearish, 18 being the most bullish. And you can see on the screen before you that as it went through February and March, just looking at, let's use SPY for an example, it was overall the trend was down as the scores got closer to 0. And then now today's score, based on today's market action, I'm doing this after the market close. It is now recovered quite healthy. A 14 out of 18 for SPY, a 15 out of 18 for QQQ, the NASDAQ 100 ETF, and a 12 for the DIA, which is the Dow Jones Industrial ETF. And so looking at the charts for SPY, you can see obviously this is all the tariff scare. Liberation Day was April 2nd, which is right there. Boom, 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 boom. And I put an anchored view app from the high, which is an all-time high for S&P 500, at the high on February 19. And after a couple days, I think it was April 4th, yeah, right, April 7th was the low after the April 2nd announcement of Liberation Day. And I put an anchored view up off the low. So what we have is the recovery, that the price action moved above the anchored VWAP from the high, meaning the buyers are back in control based off that VWAP. And that happened on May 1st. It did what I love to see it do, meaning it came back down and tested it on May 6th. So what was potentially resistance, once it got above it, it became support. That's what you want to see. And then obviously now SPY has just taken off since then. And it's all, and obviously it's held above the anchored VWAP of the low on April 7th. So all great signs, all very bullish. It's also above the Ichimoku cloud. The other thing I want to look for. The cloud is green going forward. That's something I want to see. The lagging line is above the cloud, and the price action is above the cloud. So this is a very, and obviously with the score being 14, this is a very bullish picture for it, for SPY. Okay, QQQ, the ETF for the NASDAQ 100. I mean, almost to the exact dates. In fact, I think it is the exact dates. The high was February 19. The low after Liberation Day was April 7th. Yeah, exact same thing as SPY. I had the anchored VWAP off the high. I had the anchored VWAP off the low. Price action came off the low, held above that line, which means buyers are in control off the low, which is what I want. And then it came up and it was a little bit of resistance as it hit the anchored VWAP right through the end of April, April 30th. It jumped it. And then, as I said earlier with SPY, the thing you like to see is it comes back and it tests it. Tested it on May 6th and May 7th, and then it's been off to the races since then. So another very, very bullish scenario. And when you throw the Ichimoku cloud in, saying this is like a mirror image of what we're seeing in SPY. The cloud ahead is green, the price action is above the cloud, and the lagging line is above the cloud. So all very positive signs to be in the market, as we say, or I say. When the tide goes out, all ships must sink, and when the tide comes in, all ships rise. So this is all good signs for being back in. And then finally, DIA, the ETF for the Dow Jones Industrial. Excuse me. The dates were slightly off on this one compared to NASDAQ and SPY. The high was January 31st. I had an anchored view up off that high. So all this was sellers in charge, obviously. And then after Liberation Day on April 2nd, it hit its low April 7th, which was the same as SPY and QQQ. Put an anchored VWAP off the low, and buyers have remained in charge since that low point. And then finally, DIA overtook the anchored VWAP off the high on May 12th, came back and tested it on May 15th, and now we've had 2 days above that. So outright bullish. Even it's L13 score. Its lucky 13 score is 12, so it's bullish, but it is the least bullish of the three. And with the cloud in place, we have a green cloud ahead. Great. We have the action above the cloud. Great. The lagging line is below. You really want to see that above, but it looks like it's heading in that direction. But like as I said, that from a technical standpoint, this is just a slight bit weaker than the other two scenarios, but the other two scenarios are quite frankly very bullish. So all's looking good. All right, major economic news for this week. As I always point out, this is provided by Forex.com, so credit to them. Quite frankly, it's a little thin this week. As you can see today, there was really no major economic impact news. Same thing for tomorrow and Wednesday. Thursday, every week, the unemployment claims come out. That's always a closely watched number. This week is forecast to be 230,000, and the same day flash manufacturing PMI comes out, flash services PMI comes out, and then existing home sales all come out that day. So clearly the most active day of the week. Otherwise a very quiet week. On Friday, new home sales comes out. So all the home sale numbers come out this week. And that's what to watch for this week during your trading, understanding that Thursday morning, 8:30, 9:45 is when those major news releases come out. It could cause a little volatility in the market, so just be aware of that for any trading you may be doing during that time. And that's what we have for economic news. Okay, now let's go into what we were doing during the market panic related to the tariffs. There were essentially two positions. Ultimately, we held them through the panic. We just kept collecting premiums on selling the calls, which is basically the strategy. And just while we're waiting or collecting the premiums on the calls, eventually the two positions it was CHWY and TWLO. CHWY is basically the online pet supply company, and TWLO is TWLO Communications software and cloud-based solutions for communications. Chewy was sold out first, and I'll bring that chart up in a minute or a second here. And that because that one recovered, Chewy recovered faster. TWLO we're still in. We're still waiting for the break even on this, and let's go into a little bit of detail about that. And I'll start with Chewy. Okay, Chewy. So we got in on February 28th, which is this arrow right here, and our entry price was 37.20. And obviously after that, it just went down with all the tariff news going on all the way into early April when Liberation Day occurred, which was pretty close to the low on this position. But as you can see, based on the buy point of 37.20, let's just estimate it right about there, to that low, roughly about a 20% decline that we had to wait out. But during the time we were able, so the idea is to sell calls obviously above your cost basis, which was 37.20, this green line here. It gets more difficult for anybody familiar with the options to sell the calls at anything that's worth any value when you get 20% below your price. So there's a couple different ways you can handle that if this happens to you. You can sell a call below your cost. The risk in that is if you get called out early, before expiration date, you will get called out at a loss because you have a strike price below your break even. Let's just say you had a strike price, whatever, $35, right? Right in this line right here. So that's the risk with that. Now, to mitigate that is if you can, as the price action gets close to your line, your strike price, you buy back and roll out because you don't want that called away from you. You don't want that option to expire in the money. And then being in the money, it's at a loss to you because I own it at 37.20 and I'm going to have it taken away from me at 35. So you buy back, roll out. Now, we didn't necessarily do that. The other way you can handle this, besides waiting it out, there's actually three. One is just outright selling calls that are below your cost, which you have that risk of getting called out at a loss. Just so you know, also that's more prone to happen with dividend stocks, especially when you get around the ex-dividend date, FYI. And options have the increased potential of getting called out once you get within that 20-day window of expiration. Now, most of what we deal with is within 5 days. I mean, today's Monday. I would happily sell a call that's going to expire on Friday, but only if I know that if that gets taken away from me, it's going to be at a profit compared to what my cost is. If that's not the case, then I'm selling options that are more than 20 days out, so that it greatly reduces the risk of getting called out on that. So one is you buy back and roll out. You're selling on option premiums that are below your cost. You're managing it by buying back and rolling it out if it threatens to expire in the money. And number two is you can buy more shares to cut your cost basis. So if you had 100 shares of Chewy at 37.20 and maybe at the low, which was around $30, whatever the close was, probably on this day right here, close $31, buy another 100 shares. Now your cost basis is going to be somewhere in the middle here without doing the math. Let's say $35 for the sake of the conversation. Now instead of 37.20, you're trying to sell calls above 37.20. Now you're trying to sell calls above 35. If you took that tactic or that strategy. You would only want to do that if you still have confidence in Chewy. Like we know this recent market downturn for almost any stock that you were in, if it was very strong when we bought it on the 28th, there was nothing particular about CHWY or TWLO that caused me to say, hey, I don't want to own that anymore, just cut my losses and move on. I knew that this was basically the tide going out. It wasn't specific to the company. It was a macro situation. And I knew with the tide going out, that I don't have a problem weathering the storm with this stock because as I've described this before as when you're selling call options against the position that you're long in, as long as to use the analogy of a rental unit, right? You own a rental building. As long as the building is sound, just keep collecting the rent. It doesn't matter if the real estate market, for the analogy that I'm using, if the real estate market comes down on you and you're negative, you're upside down in the property, you're still collecting rent. You're still making money on it. You just you ride it out and you just make your money through the premiums. And that's basically what this was. So I think down towards the bottom, there was a period of a few weeks where there just was not any value in selling calls above anything that was above the 37.20 price. But as soon as this started recovering, then the calls started coming back and they started showing their value. And overall, as the price got right up here, there were a couple of weeks where we were selling it above the cost, the 37.20 cost, and our last position, which was off that expired on the 9th, was this one right here for 38.50. So we sold the 38.50 call. It moved up above the 37.20. It closed above the 38.50 on the 9th, which is this candle right here. And so we ended up on the stock, we ended up with 6.4% profit. This is something that was down 20% on roughly about 20% on April 7th, keep in mind. So by May 9th, we're now sitting here going, okay, now we got 6.4% profit. It got called away from us. And all the premiums that we were able to sell along the way, that gave us another 4.8% on this, just on the premiums alone that we sold off. So overall, it's 11.2% for basically 51 market days, if you count the number of days that we're in there. We were in the market, we were in this position for 51 market days, made 11.2% on it. And so if you annualize that, that's 57% if you do that repeatedly throughout the year. Not bad at all. Absolutely not bad. So yeah, that actually was a very good success story considering what it was looking like down here around the low of April 7. And now the next one I want to go into is TWLO, the other position we had. Okay, and then the other position, as I said, is TWLO. So same thing. Went in on February 28th, just like CHWY. Price for that was 118.70 at the time of entry, and then it just basically immediately crashed. And this one even took more of a dive. This was a little more painful to watch while we're in it. We just had to sit back and bag this thing and wait. Roughly at the low, I don't know, where's the low price right there? 30% down basically on April 8th. And again, you know, when you own stocks, you gotta have your cut loss. But in this scenario, as I said with CHWY, this was a macro situation. I knew that these stocks were sound. This is not stock specific. This is just the tide. And we waited out. And granted, we couldn't sell calls against this thing without making any decent money above our cost. But CHWY was more profitable on the premiums, so we just waited this little ride out right here. And then when it finally started getting up around early May, pricing in here, stretching for the 118, you were starting to get some value out of it, and we were able to sell calls on that. There was a lot of thought of maybe buying more shares, another doubling our position on this. So that we could cut our cost basis in half, as I mentioned earlier. But ultimately, it wasn't done, but it still may be done. And I'll explain that by showing you that as we got up into this price now, so here 118, this green line is where our cost is. So just last week we entered two positions on this, a call and a put, and the thinking here is. First of all, we sold the call at 120, with our break even or our cost at 118. So if it by this Friday the 23rd when the options expire, if it moves above 118 up to 120 or above, it's going to get called away from us, and that's fine. It gets taken away from us at a profit, which is exactly what I want. So I'm happy with that. Um, but in case this falls back, we also sold a put at 111, this purple line right here. So, and what that allows us to do, and that's sometimes, I mean, this is the way you probably should buy stocks. And if some of you are familiar with the wheel strategy, it's the same thing with the wheel strategy. You don't ever just go out and buy a stock. You sell a put underneath it because you get paid for selling that put. Now, the thing about the put is you have to buy it at that put price if it closes in the money. So if this goes below 111 and on Friday and closes down there by Friday, we're going to have to buy the shares at $111, and which is okay. That's what I want. Because that's going to cut my cost basis at 118.70. I did the math real quick. It's going to cut it down to 114.85. So so now if that were to happen, this comes down. We're getting paid to buy the stock if it goes south, right, from where it is now. We're getting paid to buy the stock. We then own more shares at 111. We own some shares at 118.70. We own more shares at 111. Our average cost is 114.85. So now we're only trying to sell calls above that 115 level rather than stretching for this 119 level that we were before. It lowers our threshold by about 3.25%. And I've said it earlier, you only want to do this if you're confident in owning more shares of that stock. Which obviously is the case here. So that's what we're in right now for up until this Friday. We made money selling the put. We made money selling the call. It's been a good week on that. TWLO was a little light on the premiums compared to CHWY, but so far we've made about almost 3%, 2.8%, specifically over 57 market days. So that's not, I mean, that's 13% annual. That's not like, I mean, most people would be happy with 13% annual. I get it. But a lot of what we're doing is, 40, 50% annual. And that's what I try to find on an annualized rate when I look at these 1 week deals that we get into. So 2.8% so far just on the premiums. If this continues to go sideways, this by Friday, that call will expire and that put will expire. And we can do this. We can put that all up again and make some more money on that. And by doing that again, and if it goes up above our call, as I said, we get it taken away from us happily and at a profit. If it goes down and below our put, then we're buying more shares and we've reduced our cost basis, and we just keep going with it that way. So that's where we're in right now. That's how we managed it through this situation. Admittedly, there was a period of time down here when it was very low where we just couldn't even collect rent on it, right? We couldn't sell premiums, but we just had to wait it out. And ultimately, if this continues to just go sideways or even maybe a little further down, that consideration that I mentioned earlier, where we were talking about, do we buy more and cut our cost basis maybe down, or our cost down around the 108, 110 level and try to sell calls there? But we didn't have to go there. We didn't do it, but that's just something to think about if you ever get in a situation like that. So that's what we're still in this. So CHWY we're out of, TWLO we're in, and that's how we basically handle it. All right, everyone, that's it for today. Thank you for your time. Thank you for watching. Click on subscribe if you're interested in getting notified when new videos come up. If you need to reach out to me, my email is mark@simplicityIW.com. And again, I appreciate your time in watching this. And remember, simplicity is the ultimate sophistication. Keeping things simple is really smart. All right, folks, have a great night. Take care. Bye.